Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, and I have Mr. Jim Welsh from Macro Tides with us, and he's here to break down this kind of choppy week as we are getting ready for next week's inflation print, right?
Yep. And I think, as I discussed in the February Macro Tides, Blake, there's a good chance it's going to tick higher for the month-over-month number. As you might remember, December was a minus 0.1, predominantly because oil and gas prices were down about 11%. Well, gas prices went up about 10% in the month of January. And the whole decline in December was because of energy. So other things were still climbing. That overshadowed it. So I think there's a good chance the read for the month-over-month for January is going to be plus 0.3. Wow. So the annual will drop from 6.5 maybe to 6.3, 6.2. But just the fact that it upticks a little bit might be a little unsettling for markets in general. Like, whoa, wait a second. Because this week we've heard a number of Fed governors talk about, well, we may have to go above what we projected in December in terms of the funds rate. So they're already pushing back a little bit. And the futures curves are starting to reflect that.
Yeah, and I'm going to jump right into your charts because I know we're kind of we're pushing it on time today, but more importantly, as you point out, interest rate expectations are shifting, and they've shifted a lot this week following the jobs report last week, and we had some hawkish central banks this week. We had Rick's Bank, we had Banxico, we had RBA, which it seems like Australia might even continue to raise rates. So it's been a bit of a hawkish reminder from other central banks that globally we still could be dealing with some pressures.
Yeah, right? With inflation. I mean, my thesis has been in the last month, if you will, that last summer everybody was looking for a recession because you had 2 consecutive quarters that were negative in GDP. And the definition, well, 2 consecutive quarters equals recession. And so everybody jumped on the bandwagon of recession. Of course, in the third quarter, GDP was up 3.2, fourth quarter was up 2.9. So now we've seen the pendulum swing where, we don't have to worry about the economy. We may not even have a recession. So Wall Street's emphasis from, oh my God, the Fed's going to keep raising rates has downshifted because the thought is, they got 1 or 2 more increases, and then they're going to be done, okay? And then later this year, they're still going to lower rates. And so as long as the economy is doing okay, Wall Street thinks that's good. They're estimating earnings to be up 10% this year. So my point is that, leading economic indicators, the yield curve, which is now more inverted than any time since 1981, lending standards this week, they were reported, went up again in the fourth quarter. Add all those up. Historically, whenever they've reached the levels, each of those, we've had a recession going back to the last 60 years. So what that tells me, Blake, is yes, the strength we saw in the third and fourth quarter going into the first quarter this year, but I think by mid-year, we're going to see more definitive signs of things are slowing. So the first chart is a picture of CEO optimism. And just like everybody else, when the economy was weak the first 2 quarters of last year, guess what? CEO confidence kept going down. Lo and behold, we got a rebound in GDP in the third and fourth quarter. CEO confidence picks up. So if their confidence picking up, they're likely to not cut spending at a minimum. And some companies might actually increase spending, which gives the economy, obviously, a lift. So, this to me is just an encapsulation of what Wall Street opinions have been regarding the economy, how they shifted since last summer. Psychologically, it's the perfect setup. Last summer, everybody was, oh my God, this is the most anticipated recession ever. And now we don't have to worry about a recession. It's the perfect time for things to start to slow down in the 4 to 6 months and catch a little bit people off guard.
All right. So, well, the next chart you bring up is Fed funds, and what's this chart suggesting to us?
Okay, so the pink line is a week ago. In other words, before the jobs report, as you noted, since the jobs report, things have changed. And the blue line is after. So before the jobs report, Wall Street or Fed funds futures were, it's going to top at 487. And by the end of this year, it's going to be down to 437. So a 50 basis point cut after June. Now what's happened is the peak is right around 5.15, which is exactly where the funds rate would be if the Fed goes to 5 to 5.25. And they're looking for about 37 basis points reduction in the funds rate. So what we're seeing is two things. They're starting to get up to where the Fed funds, what the Fed has told us it's going to be. And the back end is starting to come up a little bit as people say, maybe they are really going to hold it for the rest of the year. So my take is this is something to watch, because I believe we're going to see that blue line rise more as Wall Street, if you will, eliminates the expectation for cuts in the last part of this year. And as that happens, my guess is we're going to see dollar strength. We're going to see equities have a problem, bond yields ticking higher, and obviously gold, I think, ticking lower. So one thing everybody jumped on, I think we talked about last week about, financial conditions easing. And Powell kind of said, we watch them very carefully. All right. And my point being, in the real world, what have we seen? Mortgage rates have dropped from over 7% to about 6%. What's happened to housing activity the last 30, 60 days? Whoa, all of a sudden it's getting a bounce. So the reality is financial conditions do have an impact on the real world. And the Fed does not want to see financial conditions where they are today. As Powell also said, which was completely ignored by Wall Street last week, it's important that financial conditions reflect the tightening that we're putting in place. And this chart is showing that maybe they're finally getting the message a little bit.
That's interesting. And it looks like yields might be moving too.
Yeah, the last couple of weeks we've talked, I've noted that in the December, the 10-year got down to 340. When Powell was talking on February 1st, got down to 333. But if you look at the 30-year, 341 in December, and the best it could do was 349.8. So these kind of intermarket divergences are normally show up when you're about to see a trend change for a period of time. And my conclusion was we were going to see Treasury yields tick higher, 10-year getting up near 390, the 30-year 399, and so far, they're moving higher. This is why technical analysis can be so helpful. I think as an input to, all right, look at the economic fundamentals, what's monetary policy, but here all of a sudden we're looking for yields to go up, and so far they have.
Yeah. Let's how's it translating to dollars? Because now the dollar is actually rising alongside yields, and you were really, really bullish on the dollar the last couple of weeks, and we're getting a lift now. So where do we go from here?
I think 106 to 108, is a target. And basically what I'm saying here, Blake, is the dollar dropped from just under 115 to just under 101. The 382 retracements like 106 and something. The 50% I think is like 107.75. So all I'm looking forward is initially here to retrace a portion of the big decline that we saw. The key point I made last October when we were talking, I think the dollar is going to decline under 105. The dollar goes down, we're going to see S&P rally, Treasury yields come down, gold should rebound, because they had all kind of been working opposite that. As the dollar was strengthening last year, all the other markets were weaker. So thought here is that if the dollar rallies as expected, we'll see a pullback in these other markets. It's kind of playing out so far.
It is. All right. Well, the next chart would be gold, because gold has really, really taken it on the chin this week, and we are in the midst of a decline. So, what do you have to say to the gold bugs right now? I mean, is there more pain ahead?
I think so. Now, again, I think the CPI, like we talked, could have a surprise next Tuesday.
Sure.
Which obviously would give the dollar an additional boost and hurt gold. I think 1830 is possible. But I still think there's a chance. Again, if you look at the labeling on this chart, for those that like watching small numbers, potentially that high we saw in 1959 might be the end of wave 3, not all of the end of wave 1. In that case, this pullback is wave 4, and there may be one more pop up after we get down to near 1825-ish toward above 1959, and then a bigger decline. Ultimately, I think gold is going to make a trip down to 1825, maybe 1780. I just think it's had one heck of a run. And as long as the dollar looks like it's headed higher, I just think that keeps a lid on gold and potentially pushes it lower.
Okay, well, and just for those of you guys that watch chart patterns, there is a flag pattern. It would take us back to about 7, which is what Jim was talking about.
Yeah,
around the 1800 level. That's entirely possible as well. With the last chart you brought, Jim, was the S&P. I mean, we want to know how this is really going to affect equities. What are you seeing here? Because equities they're a little weaker. But is next week a make or break for the S&P?
Well, it has the potential. Again, I think the S&P has more of a pullback here. That bottom panel shows a breadth indicator oscillator that I use. And you can see it was really, really overbought. We're starting to unwind that. We're getting down to neutral. If I'm right about the CPI ticking higher for the month of January, we get additional weakness, I think, down near 4,000 on the S&P. But I still think that Wall Street wants to believe that the economy is the most important factor at this point. I think the economy is going to continue to show signs that it's doing okay. And I think the odds are we're going to see a rally above 41.95. If things get kind of stupid, we could get above 4,300. Again, we've talked about this, the option trading options that expire in less than 24 hours. It started with retail. Now hedge funds are doing it, Blake, and it's about 40 to 45% of daily volume. So what's happening here is the option traders are, pushing intraday. Whatever the move is, they accentuate it. So again, I think we're going to see jobs grow. It's not going to see 500,000 again. It's going to drop down probably below 200,000 for the next number. There'll be some data point that get people to think, oh, wow, everything's going to be great. So I'm not ready to get really bearish. I still believe in the second quarter and beyond, we're going to see the economy slow materially. Wall Street earnings have to come down. PE ratios then get compressed when that happens. I think a retest of 3,500 is certainly in the cards, and maybe even 3,200 if we actually do get a recession. Because historically, earnings did hit about 20%. Average decline in a recession is 36% on the S&P. So to me, psychologically, everything is set up. Worried about a recession last summer. Now we're not that worried about a recession, just in time for it to show up. It's kind of classic.
Yeah, there's definitely a lot of question marks there. A lot of people really want to be bullish, but at the same time, a recession, it seems like it's inevitable at some point this year. So I guess we're gonna have to stay tuned. And next week's gonna be a big week. So let's buckle up and get prepared for it, right?
We're ready, but first of all, we're prepared for the weekend.
Yeah, there we go. All right. Remember, folks, if you like what Jim does here every week, make sure you give him a thumbs up, subscribe to the channel. Make sure you check out Macro Tides so you can get the most recent technical report by emailing Jim Welsh Macro at gmail.com. Geez, I already know this, Jim. I did the pitch for you. Have a great weekend.
After about 100 weeks, man, you got it down. Hey, thanks, Blake. You have a great weekend as well.
All right, cool. All right, that's it. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.